Everyone I talk to right now is terrified. And I mean genuinely terrified. People are checking their portfolios every hour, watching the headlines, asking whether this is the moment everything breaks. And then I pull up the chart. The S&P 500 just hit 7,165, a new all-time high, on April 25th. While the University of Michigan is reporting consumer sentiment at 49.8, a record low. Think about that for a second. The market is at its highest point in history, and the average American feels worse about the economy than at almost any point on record. So someone is wrong. And in this video, I am going to show you exactly who. Because here's the thing, this divergence, fear at a record high, market at a record high, this is not random. This is the setup. This is where prepared investors do the work that emotional investors refuse to do. And if you are watching this and you are nervous, that is completely understandable. But nervousness is not a strategy. Let me show you what is actually happening underneath the surface. And then I will give you 3 specific stocks I think belong on a serious watch list before 2030 makes the opportunity obvious. Let me start with the market itself, because I think most people have the wrong mental model right now. When people say this market is expensive, they are using an old picture. They are comparing today to some abstract normal that may not apply anymore. Look at the actual numbers. The Magnificent Seven, the most scrutinized, most debated companies on Earth, are trading at roughly 25 times forward earnings right now. 25. The broader S&P 500 is sitting at about 23 times trailing earnings. Now go back and look at .com valuations. Those were triple-digit PE multiples. Some companies were valued on metrics that barely existed. That is not what we are talking about today. What we are talking about is a market where tech earnings have been growing strongly enough that even after the Iran conflict pushed valuations down by as much as 20% during the pullback, the prices barely moved because the earnings kept coming. The multiple compressed, the earnings went up, the math changed, and the people who sold in February because the headlines were frightening, they are sitting on the sidelines right now watching the market print new records. This bull market is 45 months old. It survived an oil shock, it survived a geopolitical war, it survived rate uncertainty, and in Q1 2026, it absorbed the Iran conflict and bounced back to all-time highs with a drawdown of less than 10%. The Nasdaq just put together a 13-day winning streak, the longest since 1992. That is not a coincidence. That is what happens when earnings growth is real and the fear is louder than the fundamentals. Now, before we get to the 3 names, I want to settle one question that I know is in the back of some people's minds. Is this just AI hype? Is this another bubble waiting to burst? I am not saying AI because it is trendy. I am saying AI because the 5 largest companies in the world just told you, in their earnings calls, on their balance sheets, in their capital expenditure plans, exactly how much they are spending on this infrastructure. The 5 biggest hyperscalers alone are planning to spend $700 billion on AI data centers in 2026. Not over 10 years, in 2026. And since October 2025, consensus estimates for hyperscaler capital expenditure from 2026 through 2030 have been revised upward by 25%. These are not projections someone made up in a presentation. These are binding commitments. And that $700 billion has to go somewhere. It has to go to chips. It has to go to memory. It has to go to cloud infrastructure. It has to go to data centers, power systems, software, and networking. The question is not whether this spending is real. The question is who actually gets the money. That is what these 3 names are about. Let's start with Oracle. Pull up the ORCL chart. In September 2025, this stock was trading at $345.72, an all-time high. By March 30th of this year, it was sitting at approximately $138. That is a nearly 60% drawdown from the peak. When a stock falls 60%, the instinct is to assume something broke. The business must have deteriorated. The thesis must have failed. And I understand that instinct. It is the natural conclusion. But here's what actually happened. While the stock was falling, Oracle's remaining performance obligations, their contracted future revenue that has not yet been recognized, reached $523 billion. That number grew 438% year over year. It grew $68 billion in a single quarter. Think about that. The stock was getting cut in half, and the backlog was exploding. OCI, their cloud infrastructure unit, grew revenue 66% year over year. GPU-related revenues jumped 177%. The cloud infrastructure run rate hit $8 billion. None of that looks like a company that is broken. So why did the stock fall? Because free cash flow went negative. That is the obvious answer. In one quarter, it went negative by roughly $10 billion. The debt load pushed above $100 billion. And the market, which is not always patient, decided to punish a company that was spending aggressively before the revenue recognized it. Positive free cash flow is not expected until fiscal 2029. That is not comfortable. I understand why people walked away. But here is the less obvious answer. The reason free cash flow went negative is that Oracle is spending $50 billion on data centers this year, up from $21 billion the year before, to build the infrastructure that its customers have already contracted $523 billion to use. This is not reckless spending. This is a company that has the orders and is now building the capacity to fulfill them. The difference is timing. The revenue is not gone, it is deferred. There is a pattern here that has a history. Amazon Web Services was widely dismissed in 2010 and 2011. It was a sidebar footnote in Amazon's earnings calls. Analysts questioned why a retail company was burning money on cloud infrastructure that generated under $1 billion annually. The people who understood what AWS was actually building and stayed patient through the confusion ended up being right in a way that was almost embarrassing to miss. Oracle's OCI is not Amazon. This market cycle is different. But the pattern of the market undervaluing an infrastructure platform in its early growth phase, that pattern repeats. Morningstar has Oracle's fair value at $220. The stock recently traded near $180. At 20 times forward earnings, for a company growing cloud revenue at 66% with $500 billion in contracted future business, the math is at least interesting enough to study. This is not a blind buy. The debt is real. The FCF pressure is real. If AI cloud demand slows or OCI misses its capacity build targets, this story gets painful fast. What I am saying is that the 60% drawdown and the recovery that has already started from $138 to about $181 between March 30th and April 21st was not random noise. Something changed in how the market is reading this story, and I want you to understand the business before the next move happens without you. Now let's talk about the thing that makes NVIDIA's chips actually function. Nobody talks about memory when they talk about AI. Everyone talks about GPUs. Everyone talks about NVIDIA. And look, NVIDIA deserves the attention. Revenue grew 73% in Q4, $5 trillion market cap. But here is something that most people gloss over. A single NVIDIA B200 GPU requires 192 gigabytes of high bandwidth memory. One chip. Now multiply that by the hundreds of thousands of B200 and GB200 GPUs that are going into data centers this year alone. An 8-GPU DGX system needs over 1.5 terabytes of HBM. Scale that across the entire hyperscaler build-out. The memory requirement is staggering. And there is one company sitting at the center of all of it that most people still think of as a cyclical commodity play. Micron Technology, ticker MU. On March 16th of this year, at NVIDIA's GTC conference, Micron announced it had begun volume shipment of HBM4, the next generation of high-bandwidth memory for NVIDIA's Vera Rubin platform. That is not a beta program. That is not a pilot. That is volume production. And Micron's entire 2026 HBM capacity is already sold out under binding long-term contracts. The whole year sold out. Here is the financial picture. Q1 fiscal 2026 revenue was $13.64 billion, up 57% year-over-year. Q2 FY 2026 guidance came in at $18.7 billion, with gross margins near 68% and EPS of $8.42. That is a company that looks more like a software business than a cyclical memory maker. And the valuation? Micron is trading at roughly 6 to 7 times forward earnings based on the Q3 guidance run rate. Compare that to AI infrastructure peers trading at 20 to 40 times earnings. The PEG ratio, which adjusts for growth, is approximately 0.2. That is one of the cheapest growth-adjusted valuations in the entire semiconductor sector right now. I know what the pushback is. Memory is cyclical. It always has been. Samsung and SK Hynix are building capacity. If AI spending normalizes in 2027, the margin expansion could unwind as fast as it came. That risk is completely real, and I am not dismissing it. But here is the part that matters. When Goldman Sachs called this the Great Memory Crunch in December 2025, most retail investors still thought Micron was just another chip name riding a wave. HBM retail prices have jumped nearly sevenfold since late 2023. The HBM market was $4 billion in 2023. By 2030, it is projected to reach $130 billion. AI data centers are expected to consume 70% of global HBM production in 2026 alone. This is not a normal cycle. When your entire year of production is sold out under binding contracts before January, that is not commodity cyclicality. That is structural scarcity. That is a completely different setup than anything Micron has seen in its history. A stock trading at 6 times forward earnings while growing revenue 57% year over year is a setup you do not see twice. This is a watchlist name, not a reason to go all in, not a guarantee of anything, but it is the kind of situation that deserves serious attention before it becomes obvious. Before I get to the third name, let me address the question I know is forming. Why not just buy NVIDIA? And the honest answer is, NVIDIA is a great business, genuinely. But at $5 trillion in market cap, you are not finding hidden value. You are joining a party that has been running for 3 years. The opportunity in NVIDIA was when it looked controversial, when people were debating whether the GPU cycle was real. That window has closed. These 3 names, Oracle, Micron, and the third one, are the ones where you might still be earlier than most. The third name is the one people will find the most boring, until they do the math. TSMC, Taiwan Semiconductor, ticker TSM. Here is the simple version of why this name belongs on this list. TSMC does not care who wins the GPU war. It manufactures chips for NVIDIA. It manufactures chips for AMD. It manufactures chips for Apple. It manufactures chips for Qualcomm, Broadcom, and a growing list of AI startups building custom silicon. Every time a data center goes online running Blackwell chips, TSMC already got paid. Every time NVIDIA sells a GPU, TSMC made it. The Vera Rubin chip, NVIDIA's next-generation platform, runs on TSMC's 3-nanometer process node. You cannot build it anywhere else. This is the toll booth on the AI highway, and the traffic is only accelerating. Look at the Q1 2026 numbers. Revenue was $35.9 billion, up 41% year over year. Earnings jumped 65% to $3.49 per share. For the current quarter, TSMC is forecasting 32% year-over-year growth, targeting around $39.6 billion in revenue. And NVIDIA has projected $1 trillion in AI data center chip sales in 2026 and 2027 combined. Broadcom is guiding $100 billion in AI chip revenue by fiscal 2027. TSMC manufactures for both. That's $700 billion in hyperscaler capex. The chips going into every one of those data centers are coming out of TSMC's foundries. The valuation is approximately 25 times forward earnings, essentially the same multiple as the Nasdaq 100. Except TSMC is expected to grow earnings more than 40% this year. You are paying an index multiple for a near monopoly in advanced chip manufacturing during the biggest compute build-out in history. The obvious concern is Taiwan. Geopolitics. That risk is real, and I will not pretend otherwise. But consider the other side of that equation. Every major hyperscaler, Google, Meta, Microsoft, Amazon, Apple, every one of them depends on TSMC's 3-nanometer process. The global incentive to protect that capability is enormous on both sides. This does not make the geopolitical risk go away. It means the risk is priced into a stock that is growing at 40% with no real manufacturing alternative at the leading edge. At 25 times earnings, with that growth profile and that structural position, this is one I would study very carefully before deciding it was too boring to own. Now, let me be honest about what can go wrong across all three of these names. Oracle's debt is high and free cash flow is negative. If OCI misses its revenue targets, or if AI cloud demand cools faster than expected, the math changes quickly. Micron is still cyclical at its core, and if Samsung and SK Hynix flood the HBM market in 2027, margin compression happens fast. TSMC carries geopolitical concentration risk that is genuinely unique. These are not safe investments. I am not here to tell you they are. What I am saying is that in all three cases, I think you are getting compensated for the risk in a way that was not available 6 months ago. The question is not whether these businesses have risks. Every business has risks. The question is whether the risk is priced. And right now, I think the evidence suggests it is. If you want the full breakdown of how I think about each of these three names, position sizing, where I would want to see the price before adding, and when I would cut, all of that is on the Patreon. The link is below. There is also a free watch list for people who just want to start tracking these names without committing to anything. Let me step back now and tell you why I called this the last wealth window before 2030. The $700 billion in AI infrastructure CapEx being spent this year does not produce revenue tomorrow. It produces revenue in 2027, in 2028, in 2029. The companies building the picks and shovels right now are pricing in the beginning of a cycle that has years to run. By 2030, this will all be obvious. Oracle's backlog will have converted. Micron's HBM position will be a mainstream story. TSMC's irreplaceability will be taught in business school case studies. The question is whether you are positioned before it becomes obvious, not after. This is not FOMO. FOMO is chasing what already ran. This is the opposite. This is studying what is still early before the crowd arrives. The market has been through this before. In 2020, a global pandemic hit. The S&P 500 dropped 34% in a month. Then it recovered and went to new highs. In 2022, the Federal Reserve raised interest rates at the fastest pace in 40 years. Stocks fell 20%. Then they recovered and went to new highs. This year, there was a war in the Middle East, oil spiked, consumer sentiment hit 49.8, a record low, and the market just printed new all-time highs at 7,165. The S&P 500 has now delivered double-digit returns 3 years in a row. This bull market is 45 months strong. The Nasdaq just ran a 13-day winning streak, the longest since 1992. The pattern is clear. The market does not care about the news cycle the way people think it does. It cares about earnings. It cares about cash flow. It cares about whether the businesses underneath the headlines are compounding or deteriorating. And in 2026, the businesses underneath the headlines are compounding harder than almost any period in the last decade. The people who sold when the Iran conflict started in early 2026, they are watching the market at all-time highs right now. That is not a comfortable place to be. And the people who are waiting for certainty before they invest, certainty almost never arrives at a price worth paying. By the time the all clear sounds, the opportunity is usually gone. That does not mean you buy blindly. It does not mean you go all in. It does not mean you skip the research and trust a YouTube video. What it means is that the prepared investor, the one who has a watch list, who understands what they own, who knows the business and the risks before the move happens, that investor is the one who survives every panic cycle and comes out the other side with something real. Markets will keep creating fear. That will not change. There will be another war headline, another rate scare, another earnings miss somewhere that sends people into a spiral. Another moment where the obvious move feels like the only move. That is not going to stop. It is never going to stop. What changes is whether you have a plan when it hits. Build the list, study the businesses, watch the data, buy slowly. Think in years, not weeks. The prepared investor is not the one who predicted everything correctly. The prepared investor is the one who had a framework before the panic started and stuck to it when the noise was loudest. That is the job. Do not panic. Do not chase. The work starts now.